Buenos Aires erupted in political chaos in December 2001 as bank accounts froze and blood spilled across the Plaza de Mayo. The Argentine government collapsed under the crushing weight of $95 billion in defaulted sovereign debt, declaring the single largest public default in modern human history. As traditional bondholders panicked and dumped paper for pennies on the dollar, a very different kind of financial predator saw opportunity in the smoking ruins of Latin America's second-largest economy. Elliott Management, an elite hedge fund operated by billionaire Paul Singer, quietly moved into the secondary bond market to buy up distressed debt. While institutional investors scrambled to recover whatever residual value remained, Elliott accumulated debt contracts for roughly 20 cents on the dollar. The fund was not looking to support a national economic recovery or negotiate a polite haircut. Instead, it was building a legal arsenal designed to convert deeply discounted paper into unprecedented sovereign leverage. The mechanism underlying this strategy was hidden inside forgotten bond covenants drafted decades earlier. Embedded within the debt documentation was a boilerplate legal provision known as the Pari Passu clause, a Latin term meaning equal footing. For centuries, this clause simply meant that a debtor could not give non-contractual priority to one creditor over another. Elliott recognized that United States contract law could reinterpret this clause into an absolute weapon of economic coercion. When Argentina launched comprehensive debt restructurings in 2005 and 2010, over 92% of bondholders accepted new restructured bonds at a steep discount. These creditors swallowed massive losses to help stabilize the nation's balance sheet. However, Elliott and a small group of stubborn holdouts flatly refused the deals. They demanded full payment on original face value plus years of accrued high-yield interest, completely breaking the unwritten rules of international debt diplomacy. The legal theater shifted directly to the United States District Court for the Southern District of New York. Judge Thomas Grisa issued a monumental ruling that altered sovereign debt markets forever. The court held that under the Pari Passu clause, Argentina was legally prohibited from paying the 92% of creditors who had accepted restructured bonds unless it simultaneously paid Elliott Management in full. This injunction effectively hijacked the entire global financial architecture. Payments routed through American intermediary banks and international clearinghouses were suddenly vulnerable to court injunctions and freezing orders. Argentina found itself trapped in an extraordinary liquidity bottleneck, unable to service its restructured debt even though it possessed the cash reserves to do so. The legal system had weaponized financial rails against a sovereign nation. The confrontation escalated beyond courtroom arguments into physical asset seizures across international borders. In October 2012, Elliott successfully obtained a court order in Ghana to detain the ARA Libertad, a three-masted naval training vessel belonging to the Argentine Navy. Holding a sovereign warship hostage in a foreign port sent a chilling shockwave through diplomatic circles, proving that no state asset was safe from private enforcement. International policymakers watched in horror as a single hedge fund paralyzed a nation of 40 million people. The International Monetary Fund and the United States Treasury warned that allowing holdout creditors to block restructured debt payments created severe moral hazard. If individual bondholders could hold an entire nation hostage, voluntary sovereign debt restructurings would become functionally impossible, destabilizing global financial markets. Inside Argentina, the political rhetoric turned fiery as leaders framed the conflict as a battle against financial colonialism. President Cristina Fernández de Kirchner publicly condemned Elliott as vulture capitalists and refused to obey what she termed imperialist court rulings. For years, the government held its ground, willing to accept technical default rather than hand over billions of dollars to holdout hedge funds. Yet the economic arithmetic continued to decay beneath the national pride. Cut off from international capital markets, Argentina suffered severe foreign exchange shortages, rising inflation, and severe currency depreciation. The cost of remaining in technical default quickly outstripped the immediate expense of a settlement. The balance sheet of the state was slowly suffocating under the weight of accumulating interest, legal fees, and economic isolation. The political landscape shifted dramatically in late 2015 with the election of President Mauricio Macri. Facing severe economic stagnation and dwindling foreign reserves, the new administration prioritized returning to international capital markets above all else. This political pivot signaled to Wall Street that the holdouts had successfully outlasted the sovereign state, setting the stage for the final resolution of the 15-year war. In early 2016, Argentina finally surrendered to the unavoidable economic realities and negotiated a massive settlement framework. Elliott Management walked away with $4.6 billion, representing a return on investment reported at over 400% on its initial capital outlay. A trade that began by accumulating defaulted paper for pennies on the dollar yielded billions in pure cash profit, fully validating the transformation of high-stakes litigation into a standalone asset class. The settlement established a dangerous and permanent playbook for distressed debt investing across global capital markets. Focusing on litigation as a primary generator of yield transformed abstract legal claims into a preferred asset class for opportunistic hedge funds. Investment firms realized that with sufficient capital, infinite patience, and aggressive legal theory, private capital could break the sovereign immunity of independent nations and extract immense guaranteed payouts. The legal precedent instantly reshaped how governments around the world issued and structured sovereign paper. Emerging market nations recognized that standard, old-fashioned bond contracts were ticking financial time bombs vulnerable to predatory holdouts. In response, international policy bodies and sovereign debt issuers began aggressively updating sovereign bond documentation, introducing collective action clauses designed to prevent minority holdouts from blocking necessary restructurings in times of crisis. These modern collective action clauses allowed a qualified supermajority of bondholders to bind all creditors to restructuring terms, effectively stripping holdouts of their hold-up leverage. At the same time, legal teams across London and New York completely rewrote the traditional Pari Passu clause to explicitly clarify that it did not guarantee equal ratable payment rights, attempting to permanently diffuse the legal weapon Elliott had weaponized. Despite these widespread contractual reforms, billions of dollars in older legacy bonds remained in active circulation across the globe. Distressed debt funds continued meticulously scanning sovereign balance sheets across Africa, Eastern Europe, and Latin America, actively searching for vulnerable legal frameworks and sovereign nations facing sudden liquidity crises. The lethal legal machinery forged in the Argentine case remained fully operational across multiple foreign jurisdictions. The ultimate victory of the fund demonstrated the cold, raw power of institutional incentives in modern finance. Unlike traditional debt holders who require target economies to recover to collect their coupons, holdout strategies thrive on financial distress, prolonged legal gridlock, and severe economic paralysis. The institutional business model aligns corporate profitability directly with exerting maximum structural pressure on a struggling sovereign debtor. This strategy altered the fundamental relationship between private capital and sovereign statehood. International law traditionally protected sovereign nations from asset seizure under the doctrine of sovereign immunity. By successfully weaponizing domestic contract law in U.S. courts, Elliott stripped away those historic protections, proving that financial markets could enforce strict collection mechanisms on sovereign governments. Developing countries now face significantly higher borrowing costs and stricter legal scrutiny when seeking international capital. Investors price in the risk of holdout litigation whenever a sovereign borrower shows signs of stress. The shadow of the Argentine litigation hangs over every sovereign debt negotiation, forcing cash-strapped nations to operate under the strict scrutiny of international hedge funds. When the Argentine conflict is examined as a forensic autopsy of modern finance, it reveals how financial engineering can redefine legal principles. Elliott Management did not invent sovereign distress, nor did it cause the initial debt default. What the fund accomplished was the systematic discovery of structural leverage points within global financial infrastructure, turning forgotten legal clauses into billions in cash flows. The permanent transformation of legal litigation into a high-yield investment asset class stands as one of the most significant structural shifts in institutional finance over the last 50 years. Specialized distressed funds now allocate billions in capital specifically to fund aggressive sovereign litigation, effectively turning international courtrooms into primary trading floors. Capital no longer merely flows toward productive economic enterprise, it flows directly into institutional legal combat. In the end, The ultimate lesson of the Elliott debt campaign is that financial contracts are only as strong as the courts enforcing them. By weaponizing sovereign debt law, private capital proved that even a sovereign nation can be brought to its knees if a determined creditor controls the plumbing of the global financial system. The ledger always demands balance, and in modern global finance, the creditor holding the legal weapon writes the final check.